Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. It was once said that we are, quote, the sum total of our experiences. In the world of investing, this rings especially true. For Nancy Tengler, the CIO of Laffer Tengler Investments, a career in money management that has spanned more than 3 decades has presented real-world challenges and opportunities that have reinforced a philosophy on risk. First, she shares that her interest in money came from not having any of it, pushing her to focus on savings and then on investing those savings. She's also come to believe that the biggest risk is not taking enough of it, a notion that is a thread throughout our discussion. This idea dates all the way back to the crash of '87, a harrowing episode during which Nancy was forced to look past the shocking volatility and argue that clients should put fresh money to work as part of a longer horizon plan. We talk about the stratospheric valuations of tech stocks in the late 90s, and she contrasts that period with today's more reasonably valued market leadership. In the present, she sees a secular tailwind coming from developments in cloud computing and in generative AI that will benefit not just the tech companies that create these innovations, but older economy stocks like Walmart that deploy them as productivity enhancement tools. Next, we discuss the balance between the macro and micro within her process. While being highly macro aware and concerned about top-down factors like U.S. government debt, Nancy's process emphasizes a study of business fundamentals along with a strong focus on evaluating management teams. Lastly, we talk about the women in finance movement and the work that Nancy is doing to promote financial literacy for females, including her book, The Women's Guide to Successful Investing. I hope you enjoy this episode of the Alpha Exchange, my conversation with Nancy Tengler. My guest today on the Alpha Exchange is Nancy Tengler. She is the CIO and CEO of Laffer Tengler Investments, a wealth management firm delivering strategies to both individuals and institutions. Nancy, it's great to have you on the podcast today.
Dean, thanks so much for having me. Looking forward to it.
One of the most fun parts of this journey for me, which is now on its 5th year in hosting the Alpha Exchange, is really the opportunity to meet people through people. And I'm grateful to Mimi Duff for introducing us and having an opportunity to introduce you to the audience that listens to the Alpha Exchange. So you've had a long and distinguished career in markets and finance and doing a lot on behalf of women in our industry as well. So lots to talk about. Let's get the conversation underway and just learn a little bit more about yourself. As I said, you've been in the industry for quite some time. Take us back to the beginning. What is it that sparked your early interest in finance? And perhaps share with us a little bit about the early days of your career.
I came from a single parent home. My dad left when I was about 12. My mom worked 2 jobs. I got a job. My brothers got jobs. It was sort of the counter to what's going on right now, the 1970s, where inflation was high and all of the things that you needed, food and energy, were skyrocketing. And it was just a difficult time economically. And so my interest in money comes from not having any money. And so I determined early on that, I was going to save whatever I made, but then eventually that translated into save to invest for the future. So when I started in the business, I had the good fortune of working for a gentleman named Tony Spare. And Tony just kind of opened the kimono and gave me access to the strategies, put me on a strategy, taught me everything he knew. And then we became partners in Spare, Tengler, Kaplan, and Bishel when I was 29. We grew the business dramatically. I think to about $3 billion back in the 1980s, early 90s. That was a lot of money back then. I learned the importance of discipline and the importance of sticking with your discipline.
Well, $3 billion is a lot of money now, too. Back in the late 80s, that's an extraordinary amount of capital to be running. It's a vastly different time period. So I tend to sort of have all my markers based on the financial metrics that existed at the time. My own start in markets was 1991, and we were amidst I want to say an 8.5% long bond.
I think that's right.
Yeah, and there was no real segment called derivatives. The electronification of markets hadn't really been borne out yet. As you kind of go back to that period and just sort of think through running money at that time, what were the challenges that were inherent in both raising capital, but also being a steward of capital on behalf of clients way back then?
I think the disadvantages were actually advantages. Like we used to wait for the value line reports to get mailed across country. I was born and raised and started my career in San Francisco. We would joke that we would often hear the refutation of the rumor before we heard the rumor. And that gave us perspective, I believe. And one of my first institutional client meetings that I went to was right after Black Monday in 1987. And back then we put our materials together with a typewriter and X-Acto knife and whiteout. You'd cut out whatever was wrong. When we built the reports the night before, the portfolio was worth about 25% more than it was at the close of business. And so we went to the meeting and I just remember Tony saying, look, we don't know what the market's going to do tomorrow, but we do know what it's going to do over the long term. You ought to give us more money. They gave us more money. And that was a valuable lesson to me that, if you're an investor, you're investing for the next 2 to 3 to 5 years, not the next 2 to 3 to 5 weeks. I think that lesson has always given me the courage that when the wheels come off, to do the analysis and then make an informed decision about whether or not you're going to buy more or buy something else, certainly not run for the hills at just the wrong time.
It's asking you to go back a ways, but for so many, that Black Monday was a formative experience, a terrifying time, a difficult time. But of course, at least for a short period of time in the aftermath of that crash, were some kind of outrageously cheap equity levels, a good chance to put fresh capital to work. Take us through, if you can, what you recall around managing money in the aftermath of such a seismic shock downward in prices.
The good news was I was kind of young and kind of dumb. And so you have a lot more courage, I think. I believed what I had learned. And so we did put more money to work. And that's actually when our assets really began to grow, because a number of managers in the 90s, we were considered value managers. We did not use low price to book. So the first thing we had to do was explain why we were using relative dividend yield. And the reason was that companies pay the dividend out of earnings. And so you're getting a lot of information from management around the dividend increase or dividend cut. And back then you did get, a fair amount of cuts. But what we saw was that in the 90s, a lot of the major value shops, there was a meltdown in financial stocks, and they ran for the hills. And a year later, we were buying the stocks in that period. And a lot of that was me, again, not knowing that maybe we should be taking it a little easy. And we did for the most part, but we got to 1.5 times the sector weighting in the S&P. We didn't see any of those managers in the institutional searches the next year because their performance fell apart. They sold them right at the bottom and we were buying them. And so you can imagine the trajectory. It was a period of, well, I'm actually drawing an analogy today to the 1990s, which we can talk about later, but there are a lot of similarities between now and then. And it was a great time to be an investor, but you had to have nerves of steel.
I see that in some of your writing and some of your media appearances, which is, I would say, some version of don't let the optical valuation scare you away in some contexts. You have to really get to know the disruptiveness of some of these businesses. You point to the Magnificent Seven, at least some component of it, as being a cornerstone of your firm's portfolio, and just talking about earnings growth. And so that's maybe where I'd love to just go back to the mid 90s into the late 90s as we entered another new paradigm, that tech bubble. I remember Greenspan famously said, I think it was 1996, made his comment about irrational exuberance, which, I think sparked a sell-off all of one day in the NASDAQ before it resumed its upward climb. I'd love for you to reflect on that period, just as someone I think that's pretty steeped in fundamentals. What was that period like, and what transition in thought process or in risk management did it require you and your firm to pursue at that time?
One of the things I really liked about Alan Greenspan is he didn't say very much very often. I wish our current Fed and the board of governors would take a page out of his book. There's just too much jawboning and data and conflicting data. But back then, if he spoke, the market did listen. And what I do think, however, is that I don't know that we really had irrational exuberance at that point. I think we got there by the end of the decade when we were measuring clicks and eyeballs, and the valuations, got to 100 times peak earnings for Cisco, 51 times peak earnings for Microsoft, which, by the way, is only trading at 30 times now. And when you compare the robust growth drivers that they have today that they didn't have then, I think you can make a pretty compelling argument that technology stocks are not overvalued, as some would argue. Certainly not like the four horsemen. And by the way, talk about concentration. We had the four horsemen. It was Cisco, Intel, Microsoft, and Dell. So hardware, really, really lofty valuations. And well, you asked about back then. It was easy, honestly. And I think that's one of the reasons why the baby boomers are so comfortable with equities, because we were contributing to our 401ks during that period. The NASDAQ was up over 800% in the 90s. Dow and S&P were both up around 440%. And it's quite a return in 10 years. There were certainly periods of volatility. We wanted to be careful about sector overweights and underweights, but in general, there were a lot of great companies to buy, and we enjoyed it very much.
How do you balance the enthusiasm that comes from what really do appear to be, and I think even in hindsight were path-breaking technological developments, the internet and the speed with which data was collected, the way in which we do business online? Firms like Amazon, initially lampooned as a bit of a joke. Amazon.bomb turns out to be one of the top 5 most valuable companies in the world, at least at some point. So how do you balance the excitement and then, of course, the positive feedback on price and wealth that comes from a market that's pushing higher so fast versus, as you mentioned, valuation metrics that, number one, get created out of thin air to justify it, and two, just become really difficult to grow your way into? What's that balance of the FOMO, or the real risk of missing out, versus buying at just elevated prices that are unsustainable?
I think one of the differences now is that we're not at peak earnings like we were at the end of the 90s. And so you can look at these companies, look at the total addressable market for digital solutions, cloud computing, generative AI, and you can come to some conclusions about the secular tailwind that I believe is behind this. But I would point out in the beginning of the decade of the 90s, we had a famous economist come speak to our clients, and he said that the US economy was only going to grow 1% to 2% into perpetuity, that we had passed our peak. But what he didn't account for was Microsoft. And the 90s were also a period of tight labor. And so companies spent on technology, and productivity boomed during the decade. And I think that is analogous to now, where we have a tight labor market. Companies are spending on productivity solutions. And so our investing theme has been, and probably will continue to be for some time, old economy companies that are embracing the digital revolution. And that would include cloud computing and generative AI, and then the suppliers of the tools that you need to do that. A recent speech I gave, I just drew a comparison between some of the names that we owned that had embraced and pivoted to digital. So one of those is Walmart versus Kohl's, which their idea of technology was, hey, you can bring your Amazon packages back and drop them off here. And so, if you look at the trailing 5-year return, Walmart's up almost 80% and Kohl's is down almost 60%. And that's the difference between a savvy management team and one that is not so savvy. And so those are the kind of names that we're on the lookout for. And really any retail investor can also identify and at least examine and make a decision about. We also compared McDonald's, which we own, to Wendy's. And McDonald's was an early adapter of digital downloads. Last year, they had 4 times new downloads than Starbucks, which has 72 million users of the digital app. And Wendy's actually shrunk their digital footprint. And so if you look at those two companies on a trailing 5-year basis, McDonald's is up 71.5% and Wendy's is up 24%. So that's the edge that we're trying to find. And just by being a consumer, most people can figure out who is embracing digitization. So one of the companies that frustrates the heck out of me is CVS as a customer. They embraced a digital application and it doesn't work. And so I finally got so fed up, I transferred my few measly prescriptions to Amazon, and it's unbelievable the difference. First of all, the price is lower. They come automatically. the transition was super easy. And I think those kinds of differences will continue to inure to the benefit of a company like Amazon, which we own, and CVS, which we got out of quite a while ago because we were just not impressed with the model.
Well, I want to talk about your views in the here and now and what you're advising and putting to work on behalf of your clients. To get to that point, I would like to rewind a little bit and perhaps start at 2022. We finish 2021 on a pretty good note. The Fed is still stuck at zero, probably to the chagrin of many, thinking it's falling further and further behind, which I think in hindsight it probably was. As we start 2022, the 3-month bill rate is 3 basis points. So we're pretty pinned at zero. And the market just gets off to a bad start very quickly. And you have, by year's end, this real decimation of a balanced portfolio of the risky and risk-free asset class. Both the stock market and bond market fall in concert. How did you guys navigate through that? What were maybe some of the warning signs that you were looking for or that pushed you in one direction? What was that period like in terms of trying to maintain capital or preserve capital in an environment where even duration as a stabilizer really failed most of us?
I would have to rewind us to 2020. So going into 2020, we just couldn't find any high quality, attractive names at reasonable valuations. And so we put a hedge on our clients' portfolios, not because we had any inkling about COVID or the economic shutdown. That helped to keep us clear-eyed during that short and swift, deep bear market. But then we got through that period and we entered August of 2020, and the yield on the 10-year was trading at 50 basis points. I just couldn't figure out how we could make money in bonds for our clients. And so I was speaking on the air quite frequently saying that our view was bonds were riskier than stocks at that point. And so we transitioned our clients out of bonds and put them in. We have a commodity strategy. Eventually, we have an inflation strategy, which we put them in a few months later. And we have a convertible strategy. We were out of the bond market when it began its big descent. And that saved our clients a lot of money because even with the bear market of 2022, stocks have done a lot better than bonds since then. Going into 2022, we were concerned, but we had made our allocation decision and we were pretty much sticking with it. So while some of our equity strategies went down, our equity income strategy, which is really a dividend growth strategy, went down significantly less than the market and its benchmark, the Russell 1000 value. And so we were able to redeploy assets as we saw yields rise into short-dated treasuries. But more importantly, we were putting money to work in growth names in the fall of 2022. And so remember, people were saying at that point, the tech trade is over. It's not going to work again. These stocks are done. We were adding risk back into our portfolios via technology and consumer discretionary names. And so we're pretty happy with that decision. We trimmed a bunch of the names in the summer of 2023. I'd written a piece at the beginning of the year that said we thought that people were way too pessimistic and we wanted to get ahead of what we thought would be a pivot in the market. And so our portfolios have done quite well this year. But in the summer, we trimmed tech and we put money to work in an overweight in industrials. And again, the names that are embracing automation and digitization and helping others do that is where our overweight is in industrials. And then on October 31st, I wrote a piece and said, hey, you should probably be adding back to some of these names and we should get a rally between now and the end of the year. And we had a great November and we're having a good December too, but we'll see what happens in the new year.
As you mentioned, the 50 basis point yield on treasuries around August of 2020, I'm thinking about period coming out of the GFC, and Jim Grant of Grant's newsletter had written a piece. I'm not going to get the exact title right, but it was something like Toxic Treasuries and Beautiful Mortgages. It's some version of there are no bad securities, only bad prices. And there's nothing wrong with the treasury bond outside of a 10-year yield of 50 basis points. It's just really hard for that to play its normal cushioning role when the starting price is a 50 basis point yield. I want to go back to your work at the beginning of the year, which was really fading the pessimism. You know, it's some version of, and I think you might have even used this term, buying in the face of bad news. You thought that market prices or perhaps the narrative and how that gets reflected in prices was overdone. That's difficult to do that. It's prices that are falling. And I believe we finished 2022, not at the low of the year, but not on a good note. So it was easy to think 2023 was going to be more of the same. I'd love for you to just expand on that a little bit more with regard to what you and your team saw and were able to look past.
First and foremost, the bears don't get to be on stage very often. And so they're kind of loath to get off. You saw the sort of chest thumping bears, and then they thought that this would continue. What we saw was managements that were not nearly as pessimistic as the analyst estimates would indicate. We sit on all the calls. We saw valuations that were pretty compelling. If you go back to October of 2022, I think Microsoft got down to $214 a share. And I should know where it is right now, but it's well into the 300s. Give me a second. This is where I kind of embarrass myself. Like, don't you know that? Yeah, it's 372. That's a hell of a move in a year and change. What we did is, and this is what you have to do in the face of periods like this, you take a very disciplined approach. You add a little bit, you add some more. We're not traders. We set a guideline and we buy up to that guideline, but we're constantly confirming it with the fundamentals. And what we saw were pretty darn good fundamentals. And the same was true during that period. We also added Spotify. We added to Chipotle. We added a position in Lululemon. So it wasn't just technology. There was companies that were executing. And what all of those companies had in common was they were exceeding expectations in 2022. So you take a name like ServiceNow, they were generating earnings growth in the 25 to 30% range. It would rally on the earnings news and then sell off again because everybody was focused on interest rates. When we got to the beginning of 2023, we thought the Fed was much closer to being done than starting the rate hiking regime. Inflation had peaked in the summer of 2022, and it was coming down, albeit from high levels. And we just thought that the picture was going to be a lot rosier than most investors thought.
Some of what you just said is my next question, which is you talked about the Fed and inflation and interest rates and the hiking cycle. And then you talked about earnings growth. My question I'd love for you to reflect on is just the macro versus the micro. I see a focus on both in both your appearances and your writing, your thinking. What's that balance like for you? How do you be very macro aware, but perhaps not let the headlines push you to trade excessively or unwind too early? How do you prioritize the corporate side versus the macro economy?
I used to manage all the wealth for the Bechtel Corporation and the Bechtel family, largest privately held construction and engineering company in the world, based in San Francisco. And I'd go to these meetings with a room full of engineers. I was young. I'd say things like, investing's about being mostly right. And you'd hear audible gasps from the engineers in the room. Can't build a bridge by being mostly right. So I think, though, that what you learn as an investor over the decades, or at least I have learned this, that investing is like being in a perpetual state of dissatisfaction. Because if you buy something and it goes up, you didn't buy enough. And if you buy it and it goes down, you bought too much. We have very defined valuation disciplines. Tony Spare developed relative dividend yield, and I began working with him early on. And we take the yield on a stock and we graph it against its own history and then compared to the S&P and set buy and sell ranges, one standard deviation from the mean. And what that does is it shows us periods, and long periods, by the way, of overvaluation and undervaluation in an effort to avoid value traps or what I call terminally cheap stocks. Our job then is to do the fundamentals, look at management, identify a catalyst for outperformance, make sure that all the quantitative factors are in line with what our expectations are and what our requirements are. And so the 12 fundamental factors, which is what we call our research, is a really important part of the exercise. And then if stock's cheap enough and it's high quality enough, we'll initiate a position. And we run pretty concentrated portfolios because we feel like if we don't have the conviction down at least 2% in the portfolio, we have no business owning it. And I think that's one of the biggest mistakes most portfolio managers make is when in doubt, they buy Home Depot and Lowe's, when in doubt, they buy FedEx and UPS, and they're very different companies. So we want to understand what we own and be able to identify if management is staying on track. And by sitting on the calls, you hear the change in tone from the management, you hear the change in tone from the analysts, and it provides you with not just the data, but perspective.
Yeah, I was just reading some quotes from Charlie Munger, obviously just passed away at 99. And one of his sayings was diversification. Really not inclined to support this sometimes obsession with trying to really sprinkle things out. It sounds like you're also of the view that conviction and really understanding these names is critical. And I think one of the things I came across in your writing on the micro side, on just the stock side, in addition to the valuation metrics, many of which you summarize, you talk about products, but also management, being on the calls, listening to change in tone and intonation. I'd love to learn a little bit more about how you think about the quality of management team. I think you referred to the CEO of Microsoft as just an exceptional CEO. How does that, just being really convicted that the folks running the firm are exceptional, how does that figure into your calculus?
It's subjective, of course, Dean, but one of the best examples I can give is Apple. We were buying the stock even before Warren Buffett and Carl Icahn. We were buying it in 2012 and 2013. And this was a period when the stock was yielding almost 3%, which was above, by the way, the 10-year at the time as well. And what we heard was that Tim Cook was no Steve Jobs. And he had the big Google Maps debacle and the stock sold off. And I would go on air and talk about it. And people would say, it's just a handset company. The other guest doesn't understand. It's just a handset company. But what we saw was the nascent services business. And that was really intriguing to us. I was also teaching college at the time, and I saw a sea of Mac computers in every class. And so while that's anecdotal, when we did the research and we looked at Tim Cook's background in terms of the supply chain and logistics, it looked to me like a pretty good decision. And so we continued to add to it. And it's a good thing that Tim Cook was no Steve Jobs, because I think the stock's up fivefold from where we bought it. And so that's an important thing to be able to discern. He may not be the new product visionary, but he sure knows how to run a company. And so when Andy Jassy took over and Amazon got cut in half or more than that, we looked at it and we said, hey, he's getting Tim cooked. And it looked to us like he was doing all the right things. He was coming on the calls. And so we bought more, and we're pretty happy we did. I think it was 88 in January, and the stock's up around 100. And we'll see, I don't know again, because I try not to pay attention on a daily basis. But yeah, it's up $147. So that's the kind of thing we look at. Are they pivoting? Are they making the right decisions? An example to the other side of that is Zillow. We initiated a position in 2022 after the stock had come down like 80%. And the old CEO had returned, and they were going to sell houses and build houses, and everything was great. Well, almost 2 weeks after we bought the stock, the CEO came on, missed earnings horribly, ended the house buying business, and was unapologetic. And so we got out at much higher levels. The stock went down to like 27. And we got out right away because this was a management that was not putting shareholders' interests first, was not communicating well. And so we got out. Now, I think it's back close to where we sold it, but that's almost a year and a half later.
One of the things I wanted to explore as well is just broadly, as you step back and think about uncertainty, we, of course, have a vast amount of geopolitical uncertainty. It doesn't seem like that's going away. Also, doesn't seem like something you can really quickly model. Some of these things are pretty out of our control. We've got the Fed hiking cycle, which seems behind us at this point, and the market now prices in cuts with more urgency than it had. And of course, the stock market has loved that. So I think we're out to the end of 2024. We're at roughly 4-ish cuts. That was about 2 a month and a half ago. So the cycle is not only done in terms of hiking, but at least from a forecasting standpoint, and market prices should reverse itself. But we do have a scenario in which the lowest interest rates in a century plus are now something much higher, even if that easing cycle does materialize. How does that fit into how you think about risks or how you allocate money either to sectors or different style classes. The interest rate shock, I'd just be curious how you guys think through the way in which companies absorb that and who's vulnerable and who isn't.
So I know there's a popular view that you should be shifting back into small caps here. And I'll probably end up being wrong about this, but in all the years that I've managed large chunks of money, small cap has mostly been difficult. You get a run up and then you get a pullback, and it's much more cyclically based. But right now, what you have is the problem that a lot of the smaller companies don't have earnings in the Russell 2000, and or they have large exposure to floating rate debt. One of the things that really struck me, and it's usually what happens when policy sort of influences markets, but again, and I'm using this example because for a reason, I mean, it's a great company, but Microsoft, Apple, most of the big companies issued debt at pre-pandemic lows and also in recent interest rate lows. Some of them used it to buy back shares. Some of them stashed cash on the balance sheet. But importantly, if you looked in the second quarter at Microsoft's balance sheet, their debt payments remained constant quarter over quarter, year over year. But their interest income increased from 2.1% rate to 3.3%. And so cash on the balance sheet rose from 552 million to 905 million. So the big got bigger, the strong got stronger. And then you factor in the fact that these companies are also going to be and have and are going to continue to do share buybacks. I mean, they kind of have to in some cases to meet the requirements of the options that they grant, but then they're also using it as a capital allocation strategy. And between the Magnificent Seven, I think they're projected to buy back over $100 billion. I think it was 140 billion in shares. And so we're back to where we were in 2021, where share buybacks are likely to put a floor under these large companies. So while I know it's not popular to say that what's working will continue to work, or that not just the Magnificent Seven, but large cap names are going to continue to outperform, I think they're going to continue at least to do very well. You're going to have that imaginary floor underneath that comes from doing share buybacks and also not having exposure to the floating rate debt problem.
I remember you had referenced August of 2020, that kind of really low yields in treasuries. Well, I remember very specifically Google issuing 30-year paper right around 2% at that time with probably $100 billion in the bank. No need for the cash other than to say this is an obvious thing to do. That bond issued at 100 is now trading at 59. Has nothing to do with Google's credit risk, of course. It's just all the interest rate move associated with it. With regard to just interest and interest expense, so you have firms like Microsoft who effectively have the creditors kind of upside down. They're earning on the cash higher than they've borrowed the money. They're buying back stock, as you said. Are there other pockets of the market where the interest rate shock you feel like is a vulnerability and is maybe yet to surface with regard to the price in the security? Which sectors are carrying debt loads, or where are the avoids just due interest rate risk?
So I think you have to pay attention to utilities. Some are better than others. You saw what happened with NEP, where they basically said, hey, we're having to pay more to borrow money. Shouldn't have been a surprise. And the stock just got absolutely clobbered. This is not rocket science, but you want to stay away from companies that have high levels of borrowing. And if you look at the sectors in terms of interest expense as a percent of revenue, real estate and utilities are the highest at around 7 and 8%. And so for me, I want to own companies that are reliable growers so they can generate earnings growth in an environment where the economy is probably going to slow. That's where I want to be focused. So that would argue against, I mean, it doesn't totally answer your question about interest rate, but it would argue against some of the consumer staples names that I think are fairly expensive. And we own some, but we're not overweight, against REITs and utilities. At some point, it's probably going to be time. And if you think the Fed's going to cut rates next year materially, then you're going to want to own some of those names as well as some of the small cap names. But I'm not sure it's a zero sum. I think there's a lot of places to make money in this environment. So I'm not going to run and jump into electric utilities with gusto. We're looking at one, we may add it, but we're not going to be materially overweight just because of the lack of growth and the high debt servicing levels.
Well, let's shift a little bit to talk about the Magnificent Seven and the time that we live in and the technological revolution in some ways that is occurring in vast parts of our lives. And some of this stuff is just moving at breakneck speed. The whole AI thing and with Sam Altman, I found pretty interesting, but it just tells you from an insider's standpoint how serious a lot of this stuff is with respect to its potential to improve our lives and to add so much productivity, but also I think some of the risks that people are afraid of. NVIDIA is often the centerpiece of all this stuff. Why don't you frame out just when you look at the kind of AI impact on productivity and then specifically the investing opportunities that emerge upstream, downstream from generative AI and so forth? What do you see and what are you guys excited about?
Well, I think the improvements to productivity clearly. And I think this notion that individuals are going to lose their jobs to AI is not well founded. Goldman did some work and said 80% of us are going to be aided by AI in our jobs, but not replaced. And I mean, that's just an estimate. I think the number will probably be much higher than that. But I think what's exciting for us is that if you go back, and I said this earlier, but if you go back and look at previous periods where there were labor shortages, 90s was one great example that's really, I think, analogous to now. What you saw was tech spending goes up dramatically and tech stock prices go up significantly as well. And so what we're looking for are the really interesting usages of AI to improve margins, to develop product, to aid in productivity, digitization that will also improve margins and efficiencies. One of the names that hasn't worked out yet for us, but I thought was very interesting was Pepsi defines themselves. The CEO on the last call said, we're a tech company that just happens to be in the beverage and snacks business. And I thought that was really interesting because if you have that view of the world, you're going to put yourself in a position to really leverage not just earnings, but cash flow generation and margin improvement. So I think that's what I'll say about that. And the total addressable market is enormous. I have some charts, which I can't find at the moment, so forgive me for stuttering, but that show the total addressable market and the compounding of the growth and the percentage of tech spend that is going to go to this space. And that, I think we're just getting started. If you look at previous super cycles, like the mainframe cycle was 20 years, and that was all IBM, 1960 to 1980. As time has passed, the PC, then networking, desktop internet, those were about 10 years. Mobile internet, same, but cloud and software as a service cut down to about 5 years. And we're just starting generative AI. That's just getting started. And that spans many companies, many iterations. I mean, I think one of the interesting companies is, I think they report today, is Adobe, that is kind of the unsung hero of generative AI. It's going to really allow all sorts of exciting usages in ad development and all sorts of graphic applications.
I saw that in some of your writing, and I'm no expert on this sector at all, so I don't know too much about it. My association with Adobe is pretty minimal. It's things like the PDF.
Me too.
It obviously goes much deeper than that. What is exciting in this? And I think you have a strong view on the management team there as well.
Very good management team. I mean, the open question, of course, is this Figma acquisition and is it going to happen? But if you look at where you can go on and say, I would like a picture of fairies in the forest, and up comes 4 or 5 options that you can pick from if you like any of them. The flexibility that gives somebody like me that can barely print my name is fabulous because you can create scenes, you can create ads if you're so inclined, you can create all sorts of views that would have taken a tremendous amount of time previously and a lot of creative work. So then there's, the cries, well, it's going to destroy creativity. I think it'll probably enhance it.
As we round out 2023 on a pretty positive note, at least annually for the stock market, and you look into next year, of course, you're always wrestling with a host of uncertainties. The only certainty is the uncertain, is the old saying. What are the things that you're worried about that keep you up at night that are kind of front and center from a risk management standpoint for you?
So it hasn't proven to be a problem yet, but I am concerned about the level of spending out of Washington. If you look at the debt servicing requirements, we have spent trillions and trillions of dollars, and some of it hasn't been spent yet. But certainly the American Recovery Act was $1 trillion that was initiated right when people were going back to work. They were vaccinated. The economy was starting to roll. And then we just threw all this money into it. And that's really what fanned the flames of inflation. And I find it kind of mind boggling that the Fed doesn't feel compelled to comment at all, as past Fed chairmen like Alan Greenspan and Paul Volcker did, and basically said, you can keep spending money, but inflation's going to keep roaring. Generally speaking, like if you just looked at the beginning of this year, the weighted average coupon on the government debt, and by the way, 50% of it matures in the next 3 years. The weighted average coupon was just above 1.8%. And that was predicted to increase interest costs by $250 billion just on the rise in the coupon rate. But then if you look at November of 2023, the weighted average cost is now over 3%. That compounding and debt servicing requirement is going to suck capital out of the private sector. And that is something I worry about. Interest expense as a percent of tax revenues has hit 14%. And the last time it did that was in 1982. What we got out of that was a hike in the payroll tax, and Social Security age eligibility was extended. I think we have to be mindful of that. And then we're on a trajectory for interest expense to exceed spending in national defense at a time when the world is a pretty scary place. So those are things I think about.
I think it's such a vulnerability. The CBO is reported that over the next decade, we'll add 10.6 trillion in just interest. I like to follow the work from the Peterson Foundation. They have some really great charts. Again, no partisan angle at all. They're just reporting the numbers, really. I came across a survey they did. They said 91% of voters are concerned that the U.S. now spends $1.8 billion per day on interest. That's about as strong a percentage you could imagine. That's almost 100%. And it's just not a topic of conversation. They never talk about it. It's unfortunate. It's quite challenging.
You didn't have to talk about it when interest rates were at zero.
It was easy to add the debt when the rate was so low. And who could have seen this coming? But here we are. Well, let's round out this conversation. I had previewed this at the beginning of our discussion. All of the work that you've done and continue to do in this field of finance, advocating for women. You've written a book, The Guide to Successful Investing for Women. I see here one of your statements here is, it's true, women make better investors than men. Sorry, guys. I like that.
Obviously, men also make excellent investors. I mean, the storied investors are mostly men, but women, the research shows they generate better performance than men in the studies that I cite. And I hope I'm citing all of them.
No, it's really interesting because I'm in the derivatives field. I have a penchant for following the blowups in derivatives. Usually there's some derivative product involved in the loss of a couple $1 billion. I have this Hall of Fame. Of the 9 folks on the Hall of Fame, none are women. And that's some combination of much smaller representation of women in overseeing large pools of capital. You're certainly one of the few, at least on a percentage basis. But it also strikes me that it may be some function of just how women think. They're a little more level-headed, oftentimes, at least you can say that in the world of finance. So just talk to us about this. So you've been on this journey for a long time, not just managing your own money, but being an advocate for others. I'd love to just open it up and ask you to reflect on what you see in terms of females managing capital. I know you've pointed to differences in how long people live as one of the unique parts of a challenge for women in terms of finance. I'd love to hear you reflect on women in managing money.
Thank you for that. And I think one of the most influential people for me on this issue was a woman named Mrs. H, I'll call her. This was early in my career. We managed about $40 million for her. She was a widow. She'd come to the meetings and she'd listen to my colleagues, talk about whatever they thought was important. And then every meeting she'd say, "So I don't understand why I don't own more in stocks." What she knew was that she didn't need the income and that the returns on stocks over the long term were much better. And so my first investing rule that I write about in the book is that the biggest risk to women's portfolios is that we frequently don't take enough risk. And so women identify as great savers. They don't like investing, generally speaking. They think it's a game or gambling. But then when you look at the research, not only do they make really good investors, in all of the studies that I cite, they generate better return because they don't take as much risk. So they're not turning the portfolio over as much. In the original study, Barber and Odine, they earned on average 1% per year more than the men. But then when it was narrowed down to single men, it was more like 4% a year. So the single men were competing with the index and generating a lot of volatility in their portfolios. But as you identified, the average age of a widow in the United States is 59 and a half. And I was 59 when my husband died, and I can tell you that it feels way too young, and nobody's been having those conversations. I shouldn't say nobody. Most people have not even thought about having those conversations. They're thinking about retiring, how they're going to spend their golden years. But it's true that the average age is 59 and a half. And then the average age of a first divorce is 30. So I used to write a column for USA Today, and they had a headline that said, "You just got married, now get ready to get divorced," which kind of unnerved me a little, but it is a fact. And so because women tend to excuse themselves from the conversation, they're not in a very strong position when this happens. And then the last thing I'll say is, and I'll blame everyone on this, but they usually don't have a relationship with the advisor their family has been working with. And so 2/3 of women end up firing their advisor within the first year. That's not good for anybody. So what I try to do in the book is educate women, make investing accessible, because it was the great Peter Lynch that said, buy what you know. And if you've been through 5th grade math, you have enough acumen to be a good investor. And then just engage them in the process through case studies of what I've learned from my uber wealthy clients, my not so wealthy clients, stock case studies that show in real time what happens when stocks sell off. Do you buy more? Do you not? And so since it's the second edition, I revisit some of the case studies I talked about in the first edition.
Women like you who have had such accomplished tenure in markets are not just adding value by teaching potential females how to invest and how to be stewards of their money, but also you're someone that young female professionals coming into the finance industry look at and look up to. And so that's also just a great value add. I've had the opportunity to host this podcast, as I mentioned, for a number of years now, and it's harder to get female guests, but I always really enjoy the conversations and hope that of my female listeners, this type of discussion really is encouraging because it shows the path that's possible. I think increasingly possible, just because there's seems to me more efforts at trying to help shape female careers in this sport called markets.
Well, that's great, Dean. Thank you for that.
Well, Nancy, this has been a wonderful conversation. I'm really glad we had a chance to have this discussion and learn a little bit more about your career, but also really how you think about markets. And what stayed with me is this idea of buying in the face of bad news, and this other idea that in some ways the biggest risk, at least if you have enough of a timeline, is not being invested.
That's right.
And so staying for the long term.
Absolutely.
Nancy, I want to thank you very much for being a guest on the podcast. It's been wonderful.
Thank you, Dean. Thanks so much for having me.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.